Hello and welcome to our first edition of Insight Edge with ASK Hedge, a series designed to empower your investment journey with knowledge and expert insights. In this inaugural session, I have a visionary leader with me, someone who has been at the forefront of developing long-short funds in India. With over 22 years of experience investing in Indian equities, he has been consistently delivering risk-adjusted returns across market cycles. It's my absolute privilege to introduce you to the Chief Executive Officer of ASK Hedge Solutions, Mr. Vaibhav Sanghavi. Hello, Vaibhav.
Hi, Harsh.
So let's start with the basics, Vaibhav. For our viewers who are new to the concept, what exactly are long-short funds?
From an overall long-short perspective, long-short funds are nothing but funds which can enable your strategy in a way where you can take long positions as well as short positions. Now, while that is an absolute basic definition of it, let me delve a little deeper in terms of what long-short is all about. Long-short in a portfolio sense is something where you take a long positions on the underlying security which you like. At the same time, from a short positions, you short sell something which on a fundamental basis you don't like. So depending upon your preference of how you go long on or short on, a combination of it is something called long-short fund. Lastly, long-short funds are the funds which enables you to hedge the overall portfolio with great efficiency and flexibility.
So, Vaibhav, is it like the long and short funds benefit from both bull and bear markets?
Of course, but it all depends on the construct of the fund. In the sense that a long-short fund has an ability to leverage, to either be a long biased fund or either can be a very low net long-short fund as well. Now all these are kind of technical jargons in that sense, but all in all it kind of gives you an ability to, or ability in terms of combined with flexibility to maneuver around or navigate around the difficult market conditions as well. I'm not saying that long-short funds are only good for difficult market conditions, but it only gives you that flexibility to give you that risk-adjusted return on an overall portfolio perspective.
Now, I understand there are different approaches to long-short strategies. Could you please take us through the ones which are mainly existing in the market?
There are many approaches, to be very honest, but let me categorize into few buckets in that sense. One, of course, long-short, if you see from a global standpoint, largest part of the long-short funds are into fundamental long-shorts. Now again, in fundamental long-shorts, it can be from a low exposure to a long biased exposure. Secondly, in terms of the second bucket, it is systematic funds, wherein the core thesis of systematic funds is driven by quant-driven funds. Okay. Lastly, in a newer modern sense, that there are various strategies which combine both fundamental long-short along with the quantitative techniques, which we term as quantum entry. So you can broadly categorize the long-short funds into these three buckets. You can maneuver around all these buckets and kind of innovate and fit to a client's portfolio.
Understood. Now, if we compare the long-short funds with the traditional ones, let's say a typical long-only equity fund, what's the biggest difference between the long-short funds and the traditional ones?
Let me take a simple anecdote first to kind of effectively explain the difference between a long-only and a long-short and in terms of the advantages as well. Now, when we talk about cricket, and I'm sure everybody is a big fan of cricket, and if you consider a test match here, because an equity investor is a long-term investor in that sense, if the conditions are overcast, you would ideally want to kind of defend and protect your wicket. At the same time, when the conditions get favorable is when you want to score pretty brisk in terms of the runs. Now, what effectively a long-short does is it defends your portfolio in a difficult market conditions by having appropriate hedges or probably an ability to short. At the same time, in a good market or good kind of overcast conditions or good climate is when you kind of go and score the runs in terms of getting those returns from good market conditions. Whereas when you compare the long only funds, they are subject to the weather patterns or weather conditions or your market conditions would say. So that's the basic difference between a long short strategy and a long only strategy.
So is it fair to say that the traditional funds, and like they ride the wave, long short funds typically have positioned themselves in such a way that they seize both the opportunities and also provide you downside protection?
That's a very good one, Harsh. Because I mentioned that long short has an ability to hedge, it does give you a substantial advantage over a long only strategy in terms of protection for the portfolios. And we know that investing is a lot behavioral in nature as well. And why we say so is because it's very good to say that you should always invest in a very bad market condition so that the subsequent returns are good. But at that point in time, because of the narrative around, it's extremely difficult to do so. Okay. If someone accepts that, then probably a better way to go is to have your products into your portfolio which navigates through the difficult times so that you don't have to make that call, right? So that's the great advantage which long short fund have over the long only.
Understood. However, we all know that investments are subject to market risk, which is a very known phenomena in the market as well. Now, this brings me to the naturally the risk profile of long short funds. What one must be looking at when they consider long short funds.
See, I think there are many risk factors, right from understanding that you should have an extremely credible fund manager who has the experience of managing that fund. Because it's a people-dependent kind of business and a strategy, any change in the team, any change in that fund manager directly impacts the returns or the performance of the strategy. That's one, which is qualitative. Okay. From a quantitative perspective, because that the fund or long short funds per se has an ability to leverage, take concentrated positions, it also comes with its own risks. Which means that if you are a larger net exposure strategy, then you have to be very, very careful that what are the underlying risks, parameters, risk control mechanisms which are inbuilt into the portfolio before entering into those strategies. So you should be looking at the amount of the net exposures, the amount of leverage, to actually determine where in the risk spectrum is your strategy and which kind of helps to position in your portfolio.
This brings me to another aspect of long short funds, which is this is also kind of a myth which we often hear in the market that long short funds typically perform well in a certain market conditions. Is that the case?
I would say that depending upon the underlying strategy, it will depend which kind of market conditions would it kind of perform. If it's a low net strategy, and what do I mean by low net? It's basically nothing but when you take your long positions and a short position, your net position is long minus short. If that net positions is pretty low, then irrespective of market conditions, you will see those strategies kind of performing. If it's a long bias, long short, and if it's a discretion oriented, which is dependent on the fund manager's discretion, you can face some amount of volatility.
Okay.
And lastly, if it's a long bias, long short, but with a quantitative angle, then probably it is much more methodical, much more clinical in that respect, right? Too many jargons, but all in all, yes, you are right in terms of deriving at a conclusion that market conditions may affect some of those strategies.
So, will it be accurate to say that this is more about adjusting the strategy rather than starting it all over?
It's not about adjusting the strategy in that sense, because every strategy will have its own risk return mechanics and spectrum. You would not want to change the strategy depending upon the market condition, or else you would lose the focus from the objective of the fund in that sense. So I would say Choose the strategy depending upon your risk return parameters and your portfolio fitment.
For someone who is looking out in this fund category segment,
What factors should be evaluated before investing in a long short fund?
Most important is the fitment in that sense, purely because if you are looking for a replacement to your debt bucket or a replacement to your equity bucket or something else, you have to be very, very clear of what you are looking for. Now, if you are looking for a replacement to your debt bucket and invest into an equity buy strategy, then your expectations are likely to get crushed in that sense. So it's very important to understand what are the underlying strategy, the risk factors, and look for value addition in that bucket rather than going across the risk spectrum.
thank you, Vaibhav, for decoding the concepts of long short funds to us and giving us a broader perspective.
Thank you, Harsh. It has been a pleasure.
In a world of rapid moves and complex patterns, long short strategies are like chess grandmasters play, which requires patience, predictive analysis, and precision. As we continue our series, we look forward to unlocking and exploring more dimensions of alternative investing with expertise, strategy, and client-first approach. Happy and smart investing.